Hello viewers, welcome to my simple accounting channel. This is Uttam Sir. Today I have to discuss the income statement and the balance sheet. Very important part of the accounting. So when you are going to do the income statement, then formally we have to make the three column, first column, second column, third column. So from the tablets, you have to collect the information. The tablets is given to your screen. Please make a screenshot of it so that you can easily understand the problem. So whenever going to do the income statement, then obviously some of the additional information or adjustment you have to be given. So each and every adjustment you have to clear idea about that. Without clear idea, you can do the income statement properly. So what are the information normally given in the additional information? So obviously I have to tell you later, but first of all I have to tell you how the income statement is to be made correctly from the additional information. When you are going to make the income statement, then first of all you have to consider three items. One item is that every adjustment will be treated at least twice. Every adjustment will be treated at least twice. Second one, you have to see some of the information, maybe some synonyms over there. So synonym may be the prepaid expense, unexpired expense, paid in advance, prepaid, unexpired, paid in advance. So this item is the peculiar items. So it is the part of the accrual accounting principle. Accrual accounting principle, part of the prepaid, unexpired, paid in advance. So all this item is there. Maybe sometimes some of the expense is still outstanding, due, area, accrued, unpaid. This is the five synonym of outstanding, the expenses which yet to be given. That is called the unpaid, area, accrued, outstanding, and due. These five elements, the synonym. So you have to remember that. But what will be the treatment of the prepaid and the accrued expenses? Prepaid expense, if it is given, so you have to treat it. Prepaid means some of the expense which not for this year but for the next year or after next year, like this. So you have already given that expense. So that is the prepaid amount. So prepaid amount, first of all you have to calculate what the amount of prepaid that is to be subtracted from the income statement. That particular expense you have to find, and it is to be given in the balance, and with that expense you have to subtract it. If it is prepaid, it is to be subtracted from the income statement, and it also go to the balance sheet under the current asset. Whenever going to do the balance sheet, then you have to put it into the current asset. So prepaid expense is to be separated from the income statement, and it is to go to the balance sheet under the current asset. Now accrued, outstanding, owing, unpaid, so some of the item is over there. So it is also the part of the accrual principles. So here maybe some of the expense yet to be given, not yet paid. So that expense also be adjusted in the income statement. If the unpaid or the outstanding, so it is to be add up with that particular expense in the income statement. Once again it is to go to the balance sheet under the current liability. You remember that. If the owing is over there, owing, outstanding, unpaid, the same thing. So it is to add up with the income statement and also go to the current liability. Remember that. Now what are the different items normally come to the adjustment? Some of the items you have to given, first of all the closing inventory, that is to be given over there. Closing inventory two-time treatment is to be over there. So it is to be add up with the subtracted from the cost of goods sold, and it is also the part of current asset. So this is the closing two-time treatment is finished. Now sometimes some of the information like this, you have to check your balance and the adjustment which is given to your screen. So make a screenshot of that. So I'm just reading over here. So since it is written over here, that's why I'm going to tell it. So second item is that revenue includes goods with selling price of 20,000 and cost price of it is the 15,000, sent to a customer on sale or return basis. This is the item sale of return basis. This is the peculiar item. Most of the cases a student is doing wrong over here. Sales or return basis. Maybe your two friends, you have some organization and another friend have the organization. So you are sending some of the goods to him, and terms is that sales or return basis. It means you are requesting to your friends, if it is possible, please sell it. If it is not possible, then you have to return to me. This is the sales or return basis. So you to see over there, two cost is over there. One is the selling price and another is the cost price. If it is the selling price, that is to be subtracted from the sales when you are going to write it to the income statement. Subtracted from the sales, as well as you have to subtract from the trade receivable. And also the cost price. Cost price is to add up with the closing inventory in the trading account, as well as it is to be added in the closing inventory in the balance sheet. Whenever you write the balance sheet, this cost price is to be added up with the closing inventory in the balance sheet. Now, some of the amount of advertisements. Advertisements is given for 4 years. Advertisement given for 4 years. So here you consider whenever you do the income statement, only 12 months period, that is 1 year times is to be applied. So it is the another principle. This is the principle of actual principle. So it is to be applied. So 3 years is prepaid. So you have to calculate what is the amount of 3 years. That is to be subtracted from the advertisements and also be retained in the current asset. Debt of pound 10,000 was considered irrecoverable, and a provision for doubtful debts is to be maintained 2% on remaining balance. It means it is given in the 4 adjustment. A debt of 10,000 irrecoverable, it is considered as bad debt. So it is to go to the income statement. Again, it also be separated from the trade receivable in the balance sheet. And you are instructed a provision for doubtful debts is to be maintained 2% of the remaining balance. It means what the amount remain, trade receivable is available. So on trade receivable, then you have to 2% is to be calculated. Then that figure is to be considered with the provision for doubtful debts, which is given in the tables in your screenshot. So you have to check it. So that calculation is to be made 2% of remaining balance. It means you have to subtract the 10,000 first of all from the trade receivable, and the figure available to you on that figure to add the 2%. You have to calculate 2% on that figure. The figure required, that is the provision for doubtful debts. Number 5, bank loan was taken 1st January. Maybe whenever you take some of the bank loan, your screenshot you have to check it. That loan was taken 1st January. So the beginning of the year. So total years interest you have to be given. You check it. The 10% bank loan. So the figure you taken from the bank. So you have to apply 10%. So that interest you have to be given. Then number 6, inventory withdrawn by the owners valued 20,000 who is not yet paid or who is not yet recorded. Maybe some of the owner taking some of the inventory which is normally sold by your organization, that is taken by some of the owner. So money is not paid. So but you have to record this. So this recording procedure of this item, maybe inventory taken. So goods taken by the owner. So it should be separated from the purchase. It should be separated from the purchase. Whenever goods taken by the owner, separated from the purchase, and again it is to be added up with the drawings account in the balance sheet. Remember that. Number 7, purchase invoice amounting to 9,000, which was included in the closing inventory, but no entry made in the purchase account. So you purchase some of the item, it is already taken into the closing inventory, but no record is made in the purchase. So what is the treatment for that? So obviously it is to be add up with the purchase. Again, it is to be add up with the trade payable accounts in the current liability. Then you are instructed. Number 8, depreciation is charged of 20% of plant and machinery using reducing balance method. There is the straight line method and the reducing balance method. Whenever you are going to make the depreciation, then obviously first of all you have to find the cost price of the machinery and also find the accumulated depreciation or provision for depreciation of that particular assets. So from cost you have to subtract the accumulated depreciation. The figure you got, on that figure you have to calculate the depreciation, that is 20%. Number 9, salary and wages outstanding. So this amount is 2000 yet to be paid, not yet paid. So it is to be added up with the salary account, and again it is to go to the current liability section in the balance sheet. Number 10, insurance will be valued up to 31st March. You see, maybe some of the organization, this organization is starting time is the 1st January, ending time 31st December. So this insurance is to be valued up to 31st March next year. So 3 months is given in advance. So this amount is to be find out first, and this is the prepaid insurance. So this prepaid expense is to be subtracted from the insurance expense in the income statement, and whatever the amount of prepaid, that is to be written in the current asset. Remember that. Then salary and wages includes 20,000 which is to be charged as drawings. Maybe erroneously in the salary and wages accounts is 20,000 is over there. So 20,000 taka is included in the salary and wages, erroneously done it. So it is to be subtracted from the salary and wages, and again it is to add up with the drawings accounts. And finally some item is that cash withdrawn from bank 8,000 for business use. Cash withdrawn from bank 8,000 for business use. If it is business use, then obviously this is to be add up with the bank account, subtracted from the bank account and add up with the cash accounts. So it is to be add up with the cash accounts, and it is to be subtracted again from the drawings account, because erroneously charged to the drawings account. So drawings account not to be charged, because the amount which is withdrawn from the bank is to be used for business purpose. That's why it is to be subtracted from the bank accounts and add up with the cash accounts. But they are charging with the drawings accounts, erroneously charged to the drawings account. So drawings account need to be subtracted, and it is to be add up with the cash in hand. So all are the 12 adjustment is over there. Now I am showing you the income statement which is already done over here. Some of the income statement is over here. So whenever you are going to do that, so you have to check it. Take a screenshot of the tables and check it, and this figure. First of all, we to write the sales or revenue item. Sales is in the tables, you got it. Sales is written over here. That is 25 lakhs sales. So and then you have to find some other item, maybe sales or return basis, that is to be subtracted, and again item returns outward. Returns inward is to be. So return inward is to be subtracted from the sales account. So here the figure is that returns inward figure, check it to a trial balance. It is 5,000, that is to be subtracted. Again sales or return basis also be subtracted. So that also be subtracted. 20,000, you check it. 20,000 the adjustment. It is to be subtracted from the sales. The figure you got, the net figure is to be written in the outer column. That is 24,75,000. 24 and 75,000. This is the net sales. Now you have to do the cost of goods sold. First item is the opening inventory. That is the 4 lakhs dollar or taka. 4 lakhs taka is the opening inventory. That is given in the tables, the debit side. You check it. Now you have to make the adjustment on purchase. So first of all, you have to find what is the purchase over. So purchase figure is 15 lakhs taka given in the tables. Now carriage inwards, you have to also found what the amount of carriage inward. The carriage inward is given in the tables. That is 15,000. And again you have to purchase omitted, some of the item which is given in the adjustment number 7, adjustment number 7, purchase omitted. So this figure also be add up with the purchase amount. And also you have to check it, returns outward. You have to check in the tables, the credit side, returns outward is over there. The figure was 6,000. And again the inventory which is taken by the owners, so that also be subtracted. So the figure is that first of all you to write purchase, then we add up the carriage inward, add up the purchase omitted, subtract the returns outward, and goods taken by the owner also be subtracted. The figure you got the net purchase. which to be written under the opening inventory. Here net purchase is 14 lakhs 98,000 is given over here. So this figure 14 lakhs and 98,000 is to be add up with the opening inventory. So the figure is got 18 lakhs 98,000 taka or dollars. So this is the total amount of purchase and opening inventory. From that figure you have to subtract the closing inventory. But whenever you are going to subtract the closing inventory, then some of the item is over there, sales or return basis, that the 15,000 taka is over there, 15,000 taka sales or return basis. So it is come back to your organization. That's why it is to be add up with the closing inventory. Closing inventory given in the 4 lakhs dollars. 4 lakhs dollars, and it is the add up sales or return basis is to be add up with it. So this figure is 4 lakhs 15,000. So this figure is to be subtracted from the above figure, that is 18 lakhs 98,000. From that figure we have to subtract 4 lakhs 15,000 from that figure. The figure is got, that is the cost of sales or cost of goods sold. So that was written under the revenue item. So from that revenue to subtract the cost of goods sold, the figure is got, that is the gross profit. This is written the gross profit. Gross profit is 9 lakhs 92,000. And we know with the gross profit some of the income item is to be add up. So here the income item is that some of the discount received given in the balance in the credit side. So discount received is to be add up. The figure you got, that figure is to be written over here, 10 lakhs 7,000. That's all the total gross profit. And now we have to subtract the all expenses. First expense is that salary and wages. But salary and wages, there the two adjustment is over there. One is that erroneously 20,000 salary and wages. You see here 20,000, that is 11. Salary and wages includes 20,000 which to be charged as drawings, but erroneously charged into the salary and wages. That's why it is to be subtracted. Look this, parenthetically written, that is 2 lakhs is salary and wages given in the balance. From that figure 20,000 is to be subtracted. Again salary and wages is still outstanding 2,000. 2,000 is still outstanding, that also be added. So here you see 20,000 plus 2,000 it is outstanding, and erroneously charged 20,000, that also be subtracted. The figure is what, that is 1,82,000 given over here, 1,82,000. Now carries outward the transporting cost of the business, that is 20,000 given in the table, and check it. Now insurance is already altogether 5,000, but out of that figure 3 months is prepaid. So that prepaid amount is to be subtracted. So 5,000 minus 1,000, then the figure is what, that is 4,000 is written over here. Then the advertisements, if some the adjustment is over there, adjustment in 3, that is written, amount of adjustment is to be made for 4 years. So 4 years, for 4 years you are making the advertisement. So 3 years is given prepaid, or it is making advance. So that's why this 3 years amount is to be find first of all. So 4 years divided by 4, then multiplied by 3, then you got the 3 years advance amount. So that amount is to be subtracted. 60,000 is total advertisements, and from that figure you to subtract the 45,000. 45,000 is 3 years advance, that is to be subtracted. This 45,000 also be written in the current asset in the balance sheet, remember that. So the figure is advertisement is 15,000. Now repairs, one of the expense, this also be written over here, the 7,000. Then discount allowed, another expense is to be written over here, 10,000. And then interest expense, you see interest expense is parenthetically written. You check it your balance, the interest expense is given already given, that's 12,000. But before doing that, you are taken the bank loan 1st January. So 1st January to December. So you have to calculate the interest. So 10% interest is over there. So if you apply 10% on 20,000, 200,000. Remember that here the balance, you check it balance, the 10% bank loan. This is the bank loan. So you have to pay 10% interest. 2 lakhs, 10% is of 2 lakhs. So the 20,000 is due over there. So you have already paid 12,000. but is supposed to pay 20,000. So is still outstanding 8,000. That's why 12,000 plus 8,000 altogether 20,000 is written over here. I'm sure it is clear to you. Now battered expense. Here the item adjustment 4. The battered amount is irrecoverable. It means the amount cannot be received by the business. So it is the 10,000. So the battered is given in the tablets is 5,000. With that figure is to be added up, and this 10,000 also be subtracted from the trade receivable in the current asset. Again, so the all together figure is 15,000. 5,000 plus 10,000. Now increase provision for doubtful debts. Provision for doubtful debts. Provision for doubtful debts given in the balance in the credit side. You check it. That is the 4,000. But right current year allowance for doubtful debts is 2%. So first of all, you to subtract the 10,000 from the trade receivable, and subtracting 10,000 from trade receivable, the figure you got, that is the remaining balance. On that figure, you to apply 2%. The 2% figure is 7800. You to use the calculator. So you got 7800. Because the previous year some of the provision for doubtful debt was kept, that was the 4,000. So figure is to be 7800, the current year provision, but previous year provision was kept 4,000. So it is to be subtracted. This figure is the increased provision for doubtful debts. So it is to be written in the income statement, that is 3800. Now depreciation. Depreciation the amount. So you are instructed depreciation is to do according to the reducing balance method. So first of all, you to find the cost of that particular asset. That was the 200,000 plant and machinery. Depreciation is to be made plant and machinery. So plant and machinery figure is 2 lakhs taka in the trial balance. So from that figure, you to subtract the 80,000 taka is given over there. 80,000 taka accumulated depreciation. So cost minus accumulated depreciation. The figure you got, on that figure you to apply 20%. That figure was the 24,000. So all expenses written. Now you to sum up the expense. It is already done. That's why I can say it. The total expense is 3 lakhs 8,800. 3 lakhs 8,800 total expense. So this expense is to be subtracted from the above, that is total gross profit. So the 10 lakhs 7,000. So subtracting this amount, the figure you got, this is 7 lakhs 6,200. 7 lakhs 6,200 net profit. This profit goes to the company owners, their pockets. This is the return of their investment, who are just making the making the company. They have to enjoy this profit, that is 7 lakhs 6,200. Sorry. Now I have to do the balance sheet. Balance sheet is not due to the space constraint. That's why balance sheet is I made myself over here. This is the balance sheet. The balance sheet is given to your screen. Please make a screenshot of it. Then you have to try to understand. So here some of the item is over here. The balance sheet, complete balance sheet, solved balance sheet is over here, and this balance sheet also printed to your screen. Please make a screenshot of it. So first of all, what is the balance sheet? Balance sheet is a statement of asset and liability at the end of the year, but at certain point of time. That is to be remembered. Balance sheet is two part. One part is the asset part, another part is the liabilities part. Equities and liabilities part. Asset part is there are two type of assets. One is non-current asset and another is the current asset. So you can start either of non-current asset or current asset. I do prefer that start from the non-current assets. Whenever going to write the non-current asset, you have to write 3 column like this. 3 column like this. So first of all, you have to write cost, then depreciation, then net book value, NBV, net book value. So whenever we are going to do that, then first of all you have to check from the trial balance what the non-current asset is available. So you see in your trial balance that the premises is 500,000. So it is written in the cost, but there is no depreciation for premises. That's why it is written directly to the outer column, estate outer column. Then land and building, the price is that 400,000. There is no depreciation for it. That's why it is written directly to the outer column. And plant and machinery. Plant and machinery you see in the trial balance, that is 200,000. And you see in the credit side of the trial balance there is 80,000 accumulated depreciation. Current year depreciation is 24,000. But here the 80,000 is previously given. So this figure is to be added up. Then if you got 104,000, that is to be subtracted from the cost price, that is 200,000. The figure you got, that is 96,000. Then you have to sum up all the non-current asset. Total figure is to be written over here. Now you have to write the current asset. Whenever you are going to write the current asset, first of all closing inventory is to be written. So closing inventory figure was 400,000, which is given under the trial balance. First adjustment. With that adjustment, you have to add up 15,000, which was sales or return basis. Some of the sales of return basis, the selling price was 20,000, cost price was 15,000. That 15,000 is to be added up with the closing inventory. Then we have to write the trade receivable. So the lot of items regarding the trade receivable. You see, trade receivable items given in the trial balance, that is 400,000. From that figure, you to subtract the sales or return basis, that is 20,000. That figure is to be subtracted. So 2 time treatment is completed for 20,000. Once subtracted from the sales, and here subtracted from the trade receivable. Again, there is the bad debt. So bad debt is given in the adjustment. So that figure, which is 10,000, given in the adjustment 4, given in the adjustment 4, that is 10,000 bad debt. It is to be subtracted from the trade receivable. Again, bad debt provision, which is the 2% of the remaining balance. So that figure is 7,800. So all this figure is to be subtracted from the trade receivable. Then the net figure you got, that is 3,62,200. That is the trade receivable. Now you to write the prepaid advertisements. Advertisement is to be remain for 4 years. That is 3 years amount is prepaid. So that figure is to be written. That is 45,000 over here. Now prepaid insurance. Again, prepaid insurance is to be valued 31st March for the next year. That's why 3 months is prepaid. So that figure is 1,000. That is to be written over here. And again, you have the cash at bank, that 100,000 over here, that is written. And again, cash in hand. Previously given it is 16,000, and you have withdrawn from the bank, that is 8,000, which is erroneously charged to the drawings account. That's why it is to be added up. For 16,000 plus 8,000, that is 24,000 altogether. So that is the cash in hand. So now all the current asset is to sum up. So the figure is 9,47,200. This is the total current asset, and you have already written the total non-current asset is 9,46,000. These two figures to add up, then you got the total assets. So total asset is 19,43,200 about it there. So this is the part of assets section. Now we have to draw the part of equity and liability section. So first of all, equity and liabilities, the capital is given, that is 600,000 is given in the trial balance. Now with that figure we have to add up the net profit figure, that was 7,06,200. 7,06,200 is the net profit. This is to be add up with the capital. Now from that figure you to subtract the drawings. So it's a lot of items regarding the drawings that is need to be adjusted. You see, drawings figure is given in the trial balance, that is 50,000. Again 20,000 you have drawn as a inventory. So owners taken some of the inventory, but no payment is made. That's why it is to be add up with the drawings. The adjustment 7 is given over here. Again, salary and wages, adjustment 11. salary and wages includes 20,000 which is to be charged as drawings. So it is to be charged at drawing, but it is erroneously charged to the salary and wages account. That's why it is subtracted from the salary and wages accounts, and once again it is to be add up with the drawings account. So these 20,000 also add up with the drawings. Now you see adjustment numbers 12, cash withdrawn from bank 8,000 for business use, but it is to be charged to the drawings account. Business use, but it was charged to the drawings account. So drawings are erroneously charged 8,000. So you have to subtract this amount. So this 8,000 is to be subtracted from the drawings. The altogether figure is 82,000. So this figure is to add up with the adjusted capital. Then the figure you got, that is 12,24,200. This is the altogether total capital balance, the adjusted capital balance. Then we have to write the long-term liability. Here the long-term liability is 10%. Bank loan is the long-term liability, that is 200,000. That is the long-term liabilities. Is written over here. Again, we have the current liabilities. Current liability first item is trade payables. So trade payables given in the trade balance, that is 500,000 in the credit side. You see it. And with this, some of the item which is in the adjustment, that item is 7 in the adjustment 7. You have the adjustment that is purchase invoice amounting to 9,000, which was included in the closing inventory, but no entry made in the purchase account. So you have bought some of the goods, but purchase was not written. So purchase and the trade payable is related. So it is to be add up with the purchase as well as it is add up also with the trade payable. That's why 500,000, that was the trade payable. With that figure we write the 9,000 which is additionally purchased. So the figure is altogether 5,09,000 given in the balance sheet. Salary and wages due, that is 2,000. 2,000 is given adjustment number 9. So you know every adjustment will be treated twice. Once it is treated to the income statement. Now it is again come to the current liability. Since it is outstanding, so it is create a liability for the business. So 2,000 is written. And interest expense, you whenever you do the income statement, you write over there in the bracket 12,000 plus 8,000. Altogether you have the interest 20,000, but already given 12,000 is still outstanding 8,000. That 8,000 is given in the adjustment. You have to consider. So that figure also come over here. That is the 8,000. So all liability is to add up. The altogether figure is 5,19,000. Then all the figure is to sum up, which is given in the outer column. So all figure, when you are going to sum up, then you got the figure, that is 19,43,200. 19,43,200 is over here. So this is the liability is matched. If the both side is equal, asset side as well as equity side, liability side is equal, then you consider the balance sheet is corrected one. So you need to practice it more and more. This is the solution given to you, but whenever you are going to make the practice, don't see the solution. You try it yourself. You just memorize the rules of making the adjustment. Once you memorize the rules, then no problem, you can do it yourself. More and more practice is to be needed. If you are interested to the better result, obviously you can follow my advice and the instruction, which will ensure you the A grade or A star number. So dear viewers, that's all for today. If the video is enjoyable to you, obviously make a like and share with your friends circles, and obviously don't forget to subscribe my channel. Thanks for watching. Have a nice time. Goodbye.